There's a new chair at the Federal Reserve, Kevin Warsh, and all eyes are on him as he steps into a challenging scene of elevated bond yields, upticking inflation, and pressure to cut interest rates. The week Warsh was confirmed by the U.S. Senate ended with one of the main credit rating agencies downgrading U.S. sovereign debt. We saw a jump in Treasury yields, with the 10-year nearing 4.6% and the 30-year moving above 5.1%, as investors also reacted to hot inflation data, rising oil prices, and fresh uncertainty tied to the Middle East. So, while the conversation for weeks had been over when rate cuts may come, the shift is now to whether they'll come at all, or if we may even see rate hikes. BofA Global Research has recalibrated its expectations, pushing potential rate cuts to late 2027. That shift makes sense. Add accelerated producer prices to the inflation equation, combine them with higher energy prices, and you have knock-on effects into sectors like transportation, goods, and consumer expectations. But there's another side to this story. Importantly, this inflation looks more driven by costs like energy rather than by overheated demand. And with the labor market still stable, moderate hiring, wage growth not reaccelerating, and low layoffs, inflation could start to ease over time if energy markets stabilize. So, how do investors think about navigating inflation risks? First, stay diversified. Inflation shocks don't hit every asset class or sector the same way, and concentration can make portfolio volatility worse. Second, for fixed income investors, higher yields could mean bonds are potentially becoming more useful again. Rather than trying to call the exact peak in yields, consider adding duration gradually and emphasizing quality. Third, where appropriate, inflation-aware tools like Treasury inflation-protected securities or TIPS can help offset some purchasing power risk, while municipal bonds may offer attractive tax-aware income for higher tax bracket investors. And finally, keep some liquidity or dry powder. If inflation headlines create broad market pullbacks, that flexibility can help you rebalance into opportunity instead of reacting emotionally. We believe for the Fed, the near-term path calls for more patience, with inflation remaining elevated but below the threshold to justify higher rates. For investors, keep focused on long-term goals over short-term noise. If inflation stays sticky, higher yields support income. If it cools, today's yields may look attractive in hindsight. Stay diversified, manage inflation risk, and use volatility to reassess, not react. And that's the Market Decode.